Welcome back to Protect the Pile, the show that brings you real practitioners talking about the markets and some key issues on investors' minds. I am Patrick Kent, or RPK, of Hedgeye Asset Management, and with me is Sam Rahman and the illustrious David Salem, both portfolio managers and colleagues at Hedgeye Asset Management. In addition, we have a special guest to join the roundtable today, Bennett Cheer, Hedgeye's restaurant analyst and ambassador of great vibes generally. Bennett, welcome to Protect the Pile.
It is a pleasure to be with you, gents, today. We have a lot of great topics that I cannot wait to get to.
Are you excited to be a part of this burgeoning media enterprise that is most likely going to dominate financial discussion in the years to come?
Of course. And I got to tell you, we got to get that intro. Whatever that music is, I need that on the black books. That is shout out to the.
I thought you were going to say you needed to just run with or something. It's like, it's a real banger. Like, just get going.
Too good. No, great to be here.
All right. Well, let's level set a little bit. I mean, I thought, kick off to the beginning of this. We did this last time. This is our second episode. So there you go. I thought we'd just kind of do a little level setting. I think the last time was Halloween, and we talked a bit about jump scares because the market gave us a little bit of turbulence around that, and we actually had a spike in volatility in the weeks prior to that when I wrote the early look. Maybe this has something to do with me doing Hedgeye media. Maybe we need to be more careful about having me on any of these things because we seem to get a spike in volatility every time I'm unleashed. I don't know. I guess I'll open it up and just let's sort of kick this around. Obviously, there's as of right now, volatility's been spiking. I think it's coming back in a little bit here. What do you think, David? Any thoughts on like what we're seeing and what you're looking at?
What I'm looking at is a very long horizon, Patrick. It's remarkably liberating to be able to look sort of through the noise and try to discern signal. I do the early look today, right, as you may have seen. And I just talked about the process and how liberating it is to say you can sort of put out all the short-term fluctuations. As we will probably discuss, I have the privilege, given my role in Hedgeye with capital allocation, of in fact, and I mean it quite seriously, using a longer time horizon. That's because we're consciously trying to keep turnover to a reasonable minimum. So I think of all the folks that are on the screen here right now, I'm kind of least qualified or informed to comment on very short-term phenomena. As you know, I do have some reflections, which I'll convey very succinctly a little bit later on the much longer horizon investment programs that I'm involved with. But let me put it back to you, Patrick.
No, that's great. I mean, I can certainly have Sam or Bennett weigh in a little bit too. I mean, it is sort of interesting to me that, there was a lot of hyperventilating yesterday, and I realized we're about 2% off the all-time high. So it's amazing how quickly that the vibes change in the market, from day to day. As of right now, I mean, I think I talked about this a little bit on X, and I'll certainly bring it up. In this meeting, I think it's a good one to remind people of is just thinking about the liquidity backdrop that we're living in, right? And so, what's something I calculate on a regular basis. It's been something that's served me well over the last probably 8 to 10 years that I've been doing this is tracking global dollar liquidity. So I just like to think I'm not alone in doing this, but I think it's a relevant metric when we consider one, how much commerce is done in US dollars globally, and then also how much financial assets that are held outside the US in dollar terms, debt that is held outside the US in dollar terms. All of that together makes dollar liquidity probably a very important part of the overall mosaic. And when I've looked at it, it's been interesting to watch that, over the last 2 months, we really saw a deceleration in dollar liquidity. So if we look at global dollar liquidity, I think as I tracked it, went kind of from like, on a 3-month annualized. That's kind of at how I think about it at the margin. We can look at the year over year is still probably up 8% year over year. But year over year is sort of less relevant, I think, than what's happening at the margin with it. And so if that's gone from like 8 to 6 to 4 to 2 to back to like three and change. And anytime, as I think of it, and I'd love to, you take some pushback if you think of it differently. But as I look at it, it's like if global dollar liquidity is growing less than kind of call it 4%, then to maintain nominal GDP activity of kind of 4.5%, you either have the activity slow or you got to liquidate assets to support that activity.
Yeah.
Um,
Patrick, can I jump in with a definitional question?
yeah,
Because we're all familiar with we've got a pyramid and a rectangle. It's a closed system. We hear that. It's in Keats' book. We hear it a lot. And it makes perfect sense to me because it causes you to focus, as our process does generally, on flows. So we
right.
get that. The question I have for you is when you talk about liquidity, we all know that in fractional reserve banking system, money can be created from nowhere, right? It
Right.
just gets conjured into existence. So the definitional questions, you can see where I'm going with this is,
Yeah, no. It's a great point because it's not tracking it. No, I think where you go, it's not really tracking M3, right? So it doesn't track necessarily where the balance sheets are relative. But as I think about it, it's kind of primary money, right? So it's basically global M2 across like most of the major economies crossed back into dollars, right? And that gives you a chance. But I think that's a great point because when I say something has to be liquidated, that's two things. You either have to sell an asset to cash it to create activity, or you need to borrow against an asset to like, which is also a way of liquidating an asset, right? Because you've reduced your ownership in it if you borrowed against it. So like, so you ultimately it's like to create more, we need either more debt creation or you need to be selling assets in order to finance the activity. Great point. And anyway, the only reason I brought this up is because, we've been kind of struggling around, we sort of crossed back under that sort of 4%, back a month ago or so. And it's been bobbling along back down at that level. And I've said this multiple times, I think, on X, where like, not surprisingly, like we should be seeing some periodic like turbulence and spikes because it's tight out there. Like it's basically, and not surprisingly with all the like the AI debt that's had to come to market, right? Everyone's sort of, hyperventilating about what that is. But of course it's going to have some impact. I mean, you're dumping a bunch of supply into a market. Like, of course it's going to have some impact, even if it doesn't necessarily have to be a credit crisis. It could just be temporary indigestion from like literally trying to eat a meal that big in a sense, right? If all of a sudden there's a lot of issuance all in short time.
Just to jump in, I think what's also exacerbating the situation now is that we've had a government shutdown for over a month. So that has impacted short-term liquidity. And you layer on the fact that expectations of what the Fed was going to do in December has changed, as Josh touched on this morning. I think those two things are probably the biggest things that have changed in terms of market expectations in the very short term, which is why you've kind of had this turbulent couple of weeks where, I mean, to your point, but let's put this in context. I mean, the lows of this morning, it was about 4% off the all-time highs. And we basically got back to, not quite, but got back to the lows from last Friday. So putting that in perspective, I think that's kind of what we have to think about as we look forward. And I think as Keith mentioned this morning or yesterday, you have to navigate the next few weeks. And, when we get the splurge of data, once the government opens up, that's going to create a lot of cross currents. And as he is very good at doing, navigating that's going to be very important, depending where we are on the VIX regime. But to David's point, I think it's a really good way to think about this is while you kind of keeping an eye on the short term, having your lens out further out into early next year and beyond, where the quad roadmap, where at least Hedgeye's quad roadmap for the next 6 months is very favorable. And investing along that and planning for that. And now, while you have this choppy market, it is probably the prudent right thing to do.
Yeah, as I'm definitely fond of saying, you can't drive the car looking in the rearview mirror, right? You have to think about what's coming next, not what's coming back. And obviously, I didn't make that up. Anything I don't attribute to someone else, it's probably just because in my senility, I've forgotten who originally said that to me, but it's a phrase that I've carried around with me for a while because it always forces you to be thinking, yeah, that's great, but what's tomorrow's news, right? Because it's today is what people are worried about, but like let's think about longer term, to David's point, or like around what's coming around the corner, that could change the conversation. And to that point, the shutdown, like you brought up, like. I mean, I've been looking at this every day. Like everybody else, the government keeps its money in the bank and it keeps its money at the Federal Reserve. And the Federal Reserve sort of checking account is ballooned to $1 trillion, right? And that will come back out. They're not going to leave it at that level. So that, it's typically somewhere around 300, 400 billion on an average basis. So, I mean, there's, any way you want to calculate, there's probably 500 to $700 billion of liquidity that should theoretically be brought back out.
Patrick, can I jump in with another question?
Yeah.
Yeah, I was told that Bennett was going to bring breakfast for all of us. Where's the breakfast? I don't.
Sausage egg wraps only travel so far, David. If you guys were in the office, we'd get you right. But
come on, man. I thought you were going to have it delivered.
You didn't bring anything back from Vegas?
Listen, all the Vegas pastries in Vegas, we left them there. We're now here. I got a nice IHOP breakfast coming to the. No, I'm joking. Nobody wants an IHOP breakfast.
Hey, Joe, maybe First Watch. First Watch is better than IHOP, right? I mean, that's
to say the least. I think a lot of people would share that sentiment, but
yeah, I don't want to disparage anybody directly, but IHOP is not on my top of my list of places to be going for breakfast generally.
Denny's,
right.
IHOP, none of the above.
All right. And so, all right. Well, let's with that, let's segue from that into the first big topic, which I actually want to kick over to David. So, David, as a preamble, right? So, you mentioned to me that you have a semi-regular meeting that you have with some asset allocator luminaries that and you have a Chatham House rules in place, which you can talk about what was on people's minds as long as you don't attribute it to anybody. I think that's you can clear me if I'm incorrectly characterizing this, but maybe I'll let you tell us about it and then what was top of mind for in that discussion. I'm dying to hear.
Yeah, I'll be very brief, Patrick, because I want to hear from the rest of you guys. But yeah, this is a group that's been meeting for several years. We meet semi-annually. We usually do one virtual and then one in person. It's usually 2 days separated by a dinner. Most recent one was last Wednesday and Thursday. And there were sort of two major topics on the table. This is about 15 or so seasoned investment pros. And most of them are managing really big piles of money for some of the biggest funds in the world. And they're pretty savvy folks. And the two topics that were on the table this time were, okay, they literally put a list of like the 24 most kind of menacing narratives that we hear about all the time. Food security, energy security, geopolitics, China versus the US. It's a long list, right? It was 24. And the question was simply, as we go around the table, and what they do normally is encourage people to speak, not for like a minute or two, like I will now, but for like 30 minutes each. Right?
Oh, wow. Okay.
It's over 2 days.
And there was an actual whiteboard.
Yeah.
Oh, wow. This is a legit.
So,
all right.
And the idea is, be candid about what you're doing. Subject to the Chatham House rule is you can summarize and paraphrase what's said, but you can't attribute it to anybody. And in this context, you can't identify the institutions who are in the room. But now everybody will know that there was somebody from Hedgeye in the room, right? So there's one breach of the rules, but it's my own breach, which is fine. Okay, so the two major questions were, okay, we got all these hazards. They've been mounting for years. Is anyone in your seats running these major institutional funds implementing material changes to your pre-existing policies, not your strategies and tactics, but policies means, the types and degrees of risk your institutions are willing to incur and guardrails and other parameters. So that was the first question. And the second question was almost a subset of the first. In this context, the elephant in the room for almost everybody except me was, what are we going to do about private equity and venture capital? Because the actual experience we're living right now, and much more specifically, the amount of cash coming back to us is a fraction of what we expected when we put together these thick plans about this is what we expect the future to hold, and this is why our policies are what they are, which have tilted very heavily, not just in recent years, but in recent decades, towards illiquid assets, on the presumption, which I think is highly mistaken, that there's a so-called illiquidity premium. I've said it before on Hedgeye TV. I think there is a premium in capitalism for a tolerance to bear what I call lumpiness, right? That's what rattles the human soul the most. As an investor, certainly, is lumpiness, right? Like, when am I going to get the reward and how big is it going to be? It's not illiquidity per se. So anyhow, in response to the first big picture question, Patrick, are you making any fundamental changes in your policies? It was stunning to me as we went around the room. The answer was almost universally, in fact, universally except for me, no. No, we see that, we see all the hazards, but we think the plans we've had in some cases in place for many years are responsive to the evolving market environment. On the second question, what about PE and VC? Clearly, maybe it's a little bit too much of what you critique, which is driving with your eye in the rearview mirror. They're starting to say we need to be more judicious. We're out over our skis still with illiquidity, and we need to cut back on fresh commitments. And final point, Patrick, and I'll turn it back to you. I want to be very respectful. I do respect everyone in the room, and I like every one of them. These are just good souls. And, not but, when queried one-on-one about what you're doing as you maintain a very heavy bias towards illiquidity, I got a uniform answer from everyone I queried. And that is, we're going to avoid big buyouts and we're going to go to the lower and middle market. And I'm sitting there thinking, okay, if the first time I heard that answer, fine. Then the third time you get a little rattled. You can see where I'm going with this. But the whole thundering herd, which has been disappointed on balance with its commitments to illiquidity, is going to steer in a different, not a different direction, but in a focused direction. And they're all going there at the same time to remedy the problem of having all gone to the same place at the same time previously. Right? It's called the fallacy of composition, right? To load.
Yeah. Well, I mean, and this actually thinks, I mean, you are literally probably one of the best people to comment on the following comment in the world. Like, it's almost like the Yale model broke everybody, right? Because it's like they all cheat off each other's homework now, right? It was one thing when someone like had great results by taking their own like strategy and going their own direction. And now they all flock like a herd together. I mean, just look at what's happened in direct lending in the last few years. It's like the word bubbled up. I mean, direct lending's been around for a long time, right? Like, but the word, suddenly that phrase bubbled up and then exploded. And now it's been growing at, 20% plus for the last 5+ years, right? So it's well over 100% plus increase in direct lending. I'm quite certain that the number of opportunities did not also expand by 100+%.
Yeah. So let me just pick up on that really briefly. Again, we want to hear from Bennett and Sam as well as you. But, I had a front row seat for the construction of the Yale model because I was working very closely with David back in the day, right? And people mistake his preference for illiquidity with an assumption that there's an illiquidity premium, which I already talked about. That's not why David took the Yale in the direction of illiquidity. He took it in the direction of illiquidity as a necessary byproduct of his presumption that he had the skill and the energy and the team to identify the very best managers in relatively inefficient niches, right? So that he was going to wind up, which he did, with top quartile or even top decile managers. And that was enough, even if the beta was producing a derisory return. The absolute total return, beta plus alpha, where the alpha was really plump, would get him where he needed to go. Now, here's the challenge, right? Not everyone can have all of their illiquid commitments in the hands of a top decile manager, autologically, right?
Everybody can't be above average, David.
And yet there was like one of the CIOs in this group that I esteem the most, really like, said, look, our challenge and I'm pushing my team, is to say, we're raising the bar. We're going to do all the illiquid stuff that we've been planning to do all along. We just need to make sure we're the top decile managers and not merely settle for the top quartile. And that's actually, ironically, consistent with David's mindset, which is, I'm in it to win, and we're going to win here at Yale. And he did, may he rest in peace. But not everybody can win in a game like that, mathematically.
Well, and the game's changed so much, right? I mean, like from when he initially cast out in that direction, now everybody has enormous allocations to this. And like, it's not novel.
Yeah. And one of the 24 factors on the list, it was maybe a little bit self-serving on the part of all the CIOs as a group, was the growing democratization of alternative investing in general and private equity and venture in particular, right? That's due to regulatory changes. That helps the Blackstones and the KKRs of the world, right? Because as a statistical matter, the amount of demand, according to experts, for illiquid from institutions is about 1/3 of the amount that the GPs are seeking to raise.
Right.
So how are they going to plug the gap? Right. They're going to plug the gap through trying to get money from what others would call retail. We would call maybe self-directed, mass affluent, and the like. And that's actually a threat to the institutions, because what's happening? The masses are coming on their playing field and making things very crowded.
Yeah.
Hey, David, just on that, can you imagine a scenario where that changes, where the allocations actually change meaningfully from, particularly away from private equity? What if you could imagine a scenario, what do you think would be the likely trigger that, or event that really gets people to reallocate to other areas? I mean, hopefully it's not failure. But I mean, can you imagine a situation that makes a distinctive move away from it?
Yes, I can. And I think we're actually maybe already in the first or second inning of it, Sam, but it might surprise you. It's actually that when you think about it, without exception, every one of the pros that was in the room that I've alluded to is a hired gun. It's not their own money, right? They may have incentives and so forth and carries, but it's not their own money. So the answer to your question, the scenario I envision, which I think has already started, is when the ultimate asset owners, those are the trustees of endowed charities, or directors of publicly, traded companies that have DB plans, the heads of family offices, the heads of sovereign wealth funds, I could go right on down the list, turn to the staff, to the hired guns, and say, Patrick, we gave you 5, 10, even 15 years. All this costly and expensive illiquid stuff has dramatically underperformed the marketable stuff. We're cutting off the spigot. And you need to get us out of this stuff. We don't want a hasty fire sale, but we want to come back 5 years from now and we want to see a much more liquid portfolio. So that's the single most likely scenario, and I think it's already starting to unfold. Final point, Sam. As with everything in capitalism, and certainly everything in investing, which drives capitalism, that pendulum, which reached an extreme probably in 2021, everybody's scrambling to get a liquid and venture, the earlier the better, that is going to swing to an unjustified extreme in the future. I cannot predict when. And that's when the environment will be opportune for a future David Swensen to come in and say, everybody else can't bear the discomfort of writing out illiquid checks. I'm now going to do it. But we are a long way from that.
Yeah. Oh my.
Yeah, that's a great point.
We just the kinetic energy is just, the potential energy is just shifting to the kinetic energy here. It has barely begun to roll downhill. And it is interesting the way you're framing this, David, because I can imagine a scenario where the more reporting that continues to happen on this type of stuff, the more it's talked about in social media, like it will bubble up to those trustees who start reading it in the news, or they hear from people, and so then they start pushing back down onto the hired guns to say like, hey, I want a better assessment of all this. And I just think what's lurking out there, right? Because, and this is kind of like, actually, this is kind of quoting you back to you. you talk a lot about beginning with risk, right? Not return. And like that risk is where you should begin your focus. And I think it's interesting because Cliff Asness talks a lot about, this illiquidity premium idea is really about volatility washing for those hired guns who produce nice graphics and credenzaware that they hand out to to the trustees to see and like, that show the returns and how smooth the returns have been over time. And then for every one of those, I sort of worry that there's in the like, as we talk about secondary funds that are buying from the primary funds and tertiary funds that are buying from the secondary funds and the direct lending that supports all of that, that there are these like pockets here of things like, and I hate to use an anecdote, but it is the one that's just sparked my imagination. Um, is that you watch like Beyond, we watched the saga of like the Beyond Meat, right? And like that was a VC investment, came out, actually was a spectacular success when you think back. It was had a huge run up. Unfortunately, the reality of the end demand of the product has driven the stock down quite dramatically to the point where despite the short covering jump in the last few weeks, it's settled in somewhere well under $1 billion of valuation. And and you compare that to like I looked up where Impossible Meat is, right? And just as a sort of an interesting thing, Impossible is still currently valued at, as best I can guess from the searching I did, $10 billion and hasn't taken a mark in like since like 2021.
Mhm.
I just, I mean, that just seems like and coming back to this point, like volatility isn't really risk. I mean, it is, but it's one way of it. It's permanent loss of capital that is actually risk. And like, so it's like pretending that you have this low volatile asset that's marked completely incorrectly
Mhm.
is a real problem, right? Like,
Yeah, well, it is, but the problem is made hugely more acute if, in fact, you need some cash, right? So, and that's where you get into the secondary market and tertiary sales and continuation funds and the like. And this is where we could talk specifically about like what's going on in higher ed, where they've had to generate a lot of cash because of what's going on in Washington. And that's when you really see, as Buffett famously said, you don't know who's naked until the tide goes out, but you do start to see that. And that, again, I was not talking in answer to Sam's excellent question about what's the most likely scenario that would cause this to change, about something that's far in the distant, over the distant horizon through the front windscreen. I was talking about what's here and now. It's already started. And I think you can see that in the concerted effort by some of these large scale alternative investment managers to really push the marketing of their services on the retail public. The retail is not a pejorative, right? It's just referring to individuals and families as opposed to institutions.
maybe
So,
I'll close out this topic. Maybe we can move on to this. Was great, David. That's a really fantastic sort of insight you given us from this. I'd love to close out this topic. Maybe trying to just kick it over to Sam and to Bennett just to see, are there any like big discrepancies between that you've sort of thought about or read about or inquired about between these sort of public private market valuations on anything? I don't know if the answer is no, that's fine. I was just curious if there are any anecdotes you've come across.
yeah, I mean, just very quickly, I think David touched on the broader themes really well, but I mean, clearly, like for like, a widget company that's public and a widget company that's private are not being valued the same way. And that's the problem. So, the GDP is the same, the economy is the same, supply chain is the same, but one's public and private. How can you have a different valuation and return expectation for the same company in the same economy, but one's public and private? So I think this is where, the chickens are going to come to roost very soon, and we'll see. But I think, and I'm talking my own book. That's kind of why I think public, I mean, public's you get marked every day. So it's the transparency about it is what I love about the fact that you can see what's going on, good or bad, every day. And but yeah, it's interesting to see like whether how different sectors clearly by affected by what's going on privately, particularly in a sector like technology, where venture cap valuations are riding pretty high with the AI theme, And but you look at valuations in the public markets, they're not unreasonable.
Right.
We could spend hours on this, but again, this is a separation between private and public. Where I think the discrepancy in what's being priced in is very different.
Right. Bennett, I want to bring you in here because you've been quiet so far. So I'm going to ask you for what is the most highly valued private restaurant company?
Oh, that's a great question. I don't know if I know that off the top of my head. I just to butt in on the conversation, I think it's interesting, what we've seen in the restaurant space specifically. We've seen lowball offers, right? Keith and I talked about this on the call a few months ago when the initial deal for Papa John's, the second iteration, I should say, the more credible one went through the $64 per share. And I said, Keith, this is big news. And Keith is looking at me like, what are you talking about for a stock that has traded 120 to $80? Like, this is a lowball offer. And I do agree, right? But it's been interesting to see, you see that. And then you also see, something like Jersey Mike's that just got acquired for $8 billion, right? So it's interesting to see that demographic and how that's changed over time.
Is Dave's Hot Chicken going to come public?
Dave's Hot Chicken, Inspire Brands just bought that up. I was at a conference, as Sam alluded to, in Las Vegas earlier this week. Dave's Hot Chicken was bought to make money. I doubt that thing will come public in the near future. But great company, and they are innovating at a very high clip, which is something that a lot of restaurants, if you aren't doing, you're severely handicapped.
I went there the other night. There's one right by my daughter's ballet studio. So I went over to, I did have some. Thankfully, the woman talked me down from the extra hot, or I really would have been in trouble.
You got to be really careful with those spice levels. I mean, it is legit.
All right. So talking about spicy, oh no, that'll make a real awkward segue. Let's move to the consumer, which is why we had, Bennett on generally. I mean, I guess, the reason I wanted to talk about it a bit is that, you look, I think the ETFs are hiding some of the actual underperformance here, because if I look at the XLY, when you exclude Amazon and Tesla, it's basically flat from December of 23. Yeah, we're coming up on 2 years. Meanwhile, the rest of the S&P is up quite a bit over that time. And you get Home Depot, year to date down 7, Lowe's down 8, Starbucks down 6, Chipotle, which Bennett laid out yesterday on the pitch, down 48% year to date. Decker's down 60%. I mean, these are just colossal moves in some of these names. And Staples are no different. I mean, they're down, 2.5% roughly year to date versus the S&P up 14. And you've got, within that, you've got Walmart up 12. You've got, Coke up 14. These are significant parts of that ETF. Under the covers, you've got P&G down 11, Kimberly-Clark down 20, Target down 33, General Mills down 26. So it's been a lot of carnage out there in the consumer space generally. And so, yeah, so like just I'll maybe, I'm doing a lot of talking here, so I'm gonna kick that out. Let's just go to you guys and sort of maybe talk about any thoughts on consumer from here, how that's shaping up into the end of the year for 2026, anything you've either read or thoughts you have about it. We'll just I'll maybe let Bennett start, since he's the one with his ear closest to the ground on what's going on out there.
You're closest to the casino, like Sam said, and like I talked about previously. I was in Las Vegas earlier this week for the restaurant.
And you look surprisingly well rested on the call, by the way, for having been in Vegas.
Thank you. I stayed on Hedgeye time, so I was on East Coast time. That's the only way that I can operate. No, but a lot of the commentary from business owners and franchisees alike was driving traffic, right? The most organic way to promote top line sales, and the concern about that, right? And this isn't doom and gloom commentary, but there is legit concern to drive traffic. And what, going to a stock level at Hedgeye, when we think about it on the consumer team, more broadly speaking, right? Daniel's more bearish, Brian's more bullish. Brian just had a great deck, a retail themes deck, noting how retail sales should outgrow PCE as a function of a variety of things in addition to tax refund boost. We've talked about this quad 3-2-1. Restaurants and consumer discretionary favors that quad 2, quad 1 window. With that said, there's plenty of longs and shorts on either side. Brian has many longs, many shorts, right? And within the same relative segment, right? Brian, not to put Brian's names out there, but TJX, Burlington on the long side, Ralph Lauren and Gap, both on the short side, all in that kind of rising inventory space, but likes them for different reasons, right? And dislikes them for different reasons as well. When I think about the signal and what Keith has, obviously signal comes out on a weekly basis. We go back and forth with Keith intra week, but that list is published every week for subscription. We have 1 signal strength long and 7 signal strength shorts. So when I think about the consumer, specifically for restaurants, it's in this gray area. And it's really, restaurants rely on that midpoint of the K, that middle third, where sentiment in October down 25% year over year. Now, consumer sentiment obviously is politically, there's bias ingrained in that number. But it is an accurate read, right? When we think about Bloomberg second measure data, September -0.6, October -2% year over year. These are credit card transactions. November down 6.3%, right? So consumers are cutting back on that visit out. At the conference, one of the metrics shown was food away from home, food at home, in the discrepancy on that, not just on a 1-year basis, but also 2- and 3-year stacks as well. When I think about as we get through this fourth quarter, we've seen a lot of stocks tumble from the third quarter, as RPK mentioned. But compares don't get that much easier in November. Black box industry same-store sales 2.8% versus a 0.4% in October. So if you thought that this was getting better for the restaurant space,
they're sort of continuing to.
Not the case.
Not a lot of holiday dinner spending. Is probably on the.
No, not quite. And it's interesting too, RPK, because you saw integrator, gents on the call, you saw within fast casual, right? If you look at aggregated same-store sales, fast casual dining, relatively flat from the second to the third quarter. QSR, a little bit of a pickup, a few basis points. We were positioned in that more short, the fast casual names. But going forward, right? The companies that will succeed going into 26 have a vision. That is so important. RPK, we talked about it on the pitch yesterday. And Chipotle's lack of a vision as they get into 26 will hinder their performance. And this reliance on improving macro is not a strategy. And I think that's incredibly important to note. You have seen a lot of brands, everybody knows compares get easier, right, throughout the year. But you haven't seen companies be rewarded for that. A lot of companies, and David, it's interesting, the response to the operating environment that you noted, right, and that not changing, that's incredibly important, right? Shake Shack's noted that, Wingstop's noted that. Obviously, those stocks traded up on the prints, communicating a strategy, communicating a vision. I've sucked up enough airtime, but
no, that was great. Yeah, no, thank you. I don't know, Sam, do you have any thoughts or questions on that one?
Yeah, that was great. I was going to add to Bennett's comments about how obviously we've, at the very short term, we've been dealing with like cyclical factors that's really hurt the consumer in terms of, let's see, cost of living. The administration, let's see, trying to deal with that with some of the decisions they're making yesterday and today and going forward. And then obviously with the government shutdown, SNAP benefits, federal pay, all these things are additive to what has been a pretty tough consumer environment. You layer on like some of the secular challenges. Again, Bennett touched on the K-shaped economy. You have that. You also have the fact that you have this big demographic shift that's happened over the country the last few years, where back when we were growing up, the Gen X and the boomers, we were like as a combined core, like a massive spending engine in the economy. And now we're like moving beyond that, where the boomers are older, some of them are dying off. We are kind of taking over that space. And the millennials and the Gen Ys are now the new sort of driving forces of spending. So the secular impact of that is that their tastes and interests and where they go to eat, shop, whatever, is completely different from where we were going. That's part of the reason why, if you look at Nike's stock price, Starbucks' stock price over the last 10 years, it's horrible. And sure, they could turn themselves around at some point with good management and sort of, managing things better around the edges. But it's a secular decline where these companies are going ex-growth, because Nike was big in the 90s when Michael Jordan was, Tiger
I was
Woods.
going to say that the biggest, most avid collectors of Air Jordans right now seem to be 50-year-old dads. So
Exactly. So like, what are the current influencers of this generation wearing? I mean, it may be Nikes, but there's many more things than Nikes now. So that's kind of what I mean. There's this secular change in consumption where this current generation, particularly Gen Y, that with social media is really dictating what is influential in terms of branding, is very different from when we were growing up and what we were spending on. So that means, like for me, when I look at the sector from an investment perspective, I see more things that I want to avoid and I don't want to buy, because existing consumer discretionary, consumer staples sector and the composition of that, 80+% of it is, in my mind, no longer growth stocks. So I'm not super interested. There could be some things that come along that could make it interesting, but with this K-shaped economy and the shifting consumption pattern, it is one of those things where there's more things you can avoid rather than buy. So a lot going on in consumer.
And
David, I don't know, do you have any?
Sam,
Oh, sorry, go ahead, Ben.
RPK, just something that Sam mentioned that's absolutely true. This change in consumption, right? A big focus, meeting consumers where they are. We did a study earlier in the year on TikTok, and specifically casual dining brands, Chili's, completely reinvented itself, reinvented its strategy. The stock took off. And a lot of that was due to TikTok and chicken crispers, which I recently had in the airport that are still delicious, by the way. But meeting consumers where they are is so important. Changing your strategy, understanding that Chipotle, as we mentioned, RPK, pressure in that 25 to 35-year-old cohort. What's Chipotle doing, right? To meet that demographic where they are. They're not doing that. And a lot of that commentary holds.
Maybe just a last comment on this, just to maybe I'll let David put the last word in. I mean, obviously you are thinking bigger picture, longer term, but at 70% of the economy, the U.S. consumer is still probably at the margin, the most influential thing that happens globally. I mean, really, from a consumption standpoint. I don't know. Any thoughts you have on this topic?
Oh, sorry, was that for Bennett or for me?
Oh, for you, David. That's kicking over you. Get the last word in here.
Not directly on the topic, but it might be an interesting last word on the topic more generally. But almost for the entirety of my career, when I look at an actively managed portfolios like Sam, I don't see just a portfolio of essentially longs. I see an index fund with a long-short portfolio on top of it. And mathematically, that's what it is. And why do I mention that? Because essentially, my take and focus and concern about what's going on with the consumer and AI as well, to an even greater extent, is that there's a fundamental misallocation of capital. So if I were in Sam's seat, for example, I'm not recommending this to Sam because Sam is way better at his job than I would ever be if I were in his seat. But I'm just making a very specific point. My maniacal focus, because I think it actually is an easier way to gain an edge, is to focus on the short side of the long-short portfolio that sits on top of an index fund for any investment program where you're measured against that benchmark. So with both the consumer, with like restaurant franchises and companies that Bennett says, I don't think, like Sweetgreen, I don't think this is going to be around in 3 to 5 years. I want to be underweight or essentially, in air quotes, short that. And with AI, for example, right now you look at Oracle and look at the CDS market. I mean, the CDS market is predicting essentially a 40% probability that Oracle is going to go bankrupt, right?
Yeah.
Now, I don't have an informed view on that. But at least from the viewpoint, if I were an active manager seeking to underweight and overweight against a benchmark, on the short side of my book, again in air quotes, I would give Oracle a careful look and say, are they permanently out over their skis to the point where the company is likely to circle the drain in the future?
That's good. I like that. That's a good last word for that topic because it'll help us segue to the next one. I'm going to do a little Q&A for the first one. I'd hoped we'd have a Q&A section of the show, and I threw it out there onto X and actually got a few responses, which is phenomenal. I hope we'll have more of those in the future. We'll be out advertising when we're going to do these, and hopefully we'll get some responses from Hedgeye Nation. But so I know I'm mindful of time, and I might lose David in about 5 minutes, so I'm going to come back to him on the question I thought you'd be best suited to talk a bit about. One of the responses I got was asking to quantify like portfolio aggregate position size by quad, or how do they understand, but to think about, minning and maxing individual asset allocation size, but not sure about how to think about it in the aggregate based on the quad outlook. So that came from at Cashworth50 on X, or it's probably C Ashworth, but I like Cashworth because it sounds like his rapper name. Go ahead.
I saw that, and again, I've already done more talking than I planned to on this episode, Patrick, and it's hard to do, particularly on the empty stomach I have because Bennett didn't deliver the breakfast, but that's for another day. So very, very briefly here, I'm all in favor. People that I've worked with know this, of like having the most robust possible system for examining all the types and degrees of risk that you've got in a portfolio, subject to the all-important constraint that you don't want to have a system for risk management that seeks to achieve a false precision, that's kind of presumes implicitly that you can know the unknowable. All right. And I know that people that are listening and watching to this episode, not all of them will be subscribers, and not all of them will have heard what Steiner said about this very topic on today's call, which was Friday, November 14th. But he already answered the question, so I'll just try to paraphrase almost.
Yeah, that's great.
Yeah. And the answer is that when you look at the way the quads work, what you wouldn't want to do is to take holdings in an existing portfolio or a portfolio that you're thinking of building and say, okay, I'm going to sort them into quads. These are my quad 1 holdings, and these are my quad 2 and quad 3 and quad 4. I wish the world would work that way. My life would be simpler and more pleasant, but it simply doesn't work that way. Lamentably, there's more complexity in that. And the way I could actually prove the point very briefly, Patrick, is if I offered you and Sam as PMs, like the following swap. Like I have a perfect crystal ball, and I know exactly which quads are going to unfold in 2026. We have 4 calendar quarters, and just assume I have a perfect crystal ball. And I say to you guys, put together, step 1, a portfolio that you think is optimal for each of the 4 quads. So you're going to have 4 portfolios, right? And then I'm going to swap you for the unknown return you're going to generate next year. I'm going to say, if you said this is my quad 2 portfolio, and my crystal ball says there's going to be a quad 2, that's the return that you're going to get on that portfolio. And if I said, how about that bargain, guys? I mean, clearly you'd love to have a crystal ball into what actually is going to unfold next year with certainty. Neither of you guys would accept that swap because you're more experienced than that. And you know that entry prices matter. The whole setup matters. It's path dependent. David, does it matter whether we're going to have quad 1 in your crystal ball in the first quarter or the third quarter? You bet it does. So again, back to the main question. I don't mind if part of the prism you're looking at, sort of assigns quads to each of these holdings, but you really don't want to push that too far. And I don't think it's a sound way to deploy capital. That said, in the programs that we're doing within my team, of course, we're giving very careful consideration to quads, but as with almost everything at Hedgeye, increasingly so, in our work, the signals trump the quad.
I've got a piece that I should finish off and actually put out sometime, one of these early looks that they asked me to do, because I have a one I've been sort of drafting for a while on sort of the interactions of signals, quads, themes, narratives, right? Like, and how to think about how these flow together, because it's never like the signals tell you more about how the quads might be different, They tell you about when the quad might be transitioning. They tell you if the themes, but then themes sometimes trump those. Like, oh, well, this normally underperforms in a quad, but this theme is so strong in the market, it's actually a difference this time. Like, it's not. So it's like there's a whole like, you know, you have to get comfortable kind of using all of these inputs and sort of going back and forth as opposed to thinking of them as strict heuristic rules to follow very accurately.
And I'll just add real quickly here because then I got to jump. But we've built the model, which I talked about in today's early look. We call it Hubble, as I think you guys all know, that tries to automate all of that, what you just talked about and more, to a prudent but not excessive extent. In other words, we rely on the model without asking it to know the unknowable. It's a delicate balance, right?
Right. Always. Yeah. Every risk model feels like that way.
The risk here at top of my head is a result of having made a bunch of mistakes on that.
You still have here.
I don't even answer, David. Yeah, that was a great answer, David.
Yeah, that's great. Well, since we're going to lose you, David, I want to, because I know you're going to have to jump in a minute. I'm going to go a little out of order quickly to get to my pop culture minute that I usually am going to do at the end of these things. And I was going with best sports movie of all time. But I got to get David Salem's pick because I think I already know what he's going to answer on this. I didn't put it on any of the prediction markets. I should have.
Yeah, I can't remember for sure, but I think you and I've enjoyed some runs with Patrick. So the answer is Chariots of Fire, but by no close second. Even though I do have a second and a third and a fourth and a fifth, but I think it's the best sports movie of all time.
Yeah, it's one of my favorites.
Yeah.
Excellent. Oh, speaking of which, we should get out for a cold weather run sometime in the next couple weeks. I have to keep the Christmas cookies off my midsection over the next month and a half. All right, David, thanks for joining. We'll continue the conversation in your absence. All right. So the other question I wanted to that came in that I thought was perfect for Sam to comment on. So the question was, when benchmarked to the S&P, what are the most important decisions to make to beat the benchmark, and how and when do you execute? And sort of as a related to that, if you're worried about a quad 4 hit, how do you think about, again, this isn't the abstract. We're not talking about actual things you're doing in the portfolio now. We're just talking about theoretically the textbook answers around this. You know, how do you think about staying invested? How do you think about risk tolerance there? So that one came from Corey Watson, who sent that.
Yeah, it's a really good question. I've talked about this in either an early look or in an appearance a few months ago, but it's great to touch on this again. So when you look at the S&P 500, which is a benchmark that I'm focused on, when you sort of break it up, the top 20 stocks make up about 47% of the index. So that's a massive number. So the way I think about it is I think about the S&P 500 as those top 20 stocks and everything else. So those top 20 stocks, I do what I can to understand those businesses and those companies as well as possible, because I want to make sure, as David touched on earlier, I'm going long short that on a relative basis within the portfolio that I manage. So I don't own all those top 20 names. I think right now I probably have like 10 of those or half of those. So if you know those companies and stocks really well, it gives me the confidence to know which one am I going to go overweight and which one am I going to go underweight. So if I make those calls right, because it's 47% of the benchmark, that gets me almost half the way towards trying to beat the benchmark. So for example, in a case where it's worked well, like this year, I owned Oracle up to that blowout earnings call where they had that big RPO number a few months ago. And then as the stock traded off after the event, it broke trade, the signals were starting to sort of deteriorate, and I got out of it. And since then, it's corrected like 25-30% from that point. So that's kind of where being long, it worked. And then when the signals changed, I got out of it, and being out of it worked. Where it didn't work earlier this year, so an example where it didn't work, I obviously, much like Jay Van Sciver, I'm not positive on Tesla medium to long term. So I do not own Tesla. But there was a period of time a few months ago where Tesla was doing really, really well. So not owning that stock really hurt me from an alpha perspective. But again, it was a short period of time, and I felt, as Jay has said many times, that the fundamentals would ultimately come to really hurt the stock, and it's starting to sort of affect it right now, and has been underperforming for the last month or so. So that's kind of where it didn't work, but hopefully it will eventually come our way in the future. And then in another situation where I've chosen to specifically avoid a couple of these names, like Visa, MasterCard, are big benchmark names. There's nothing wrong with those businesses. They're fine. I think from a rate of change perspective, there's nothing compelling on the revenue growth side or the earnings side that make them interesting right now. I think I'm much more interested in other parts of financials like Goldman Sachs and Morgan Stanley, JP Morgan, where there's regulatory relief that's going to help those companies going forward, particularly in 2026. So that's kind of more of a choice where I find better names elsewhere within the sector versus, having to own Visa, MasterCard. So those are three examples where I'm making specific choices as to what I own in those top 20 names. And that kind of drives, I think, a lot of the alpha. Hopefully will drive a lot of the alpha going forward. And lastly, on the Quad 4 question, I think, again, it's a very nuanced question because it's very much.
Yeah, to keep it theoretical, right? It's still like, it's like, again, kind of like almost like David's way of framing it. Like if you had perfect visibility is like 100% chance of a Quad 4 coming in the following quarter, like what would you be thinking about conceptually at a high level about the portfolio construction?
So conceptually, what I'm thinking about is that, I'm looking at ways to raise cash and reduce beta in the portfolio as a way to sort of inoculate myself from, risk off days in a Quad 4 environment. There's going to be a basket of stocks that I like long term that I feel like I can see through that Quad 4 month or 2 months, and I want to own those long term, much like what David described. And there's going to be some of these stocks that I will stick with because I feel really strongly about that medium to long term investment case for the stocks. But around the edges, as I said, with raising cash, reducing beta, and in some situations, maybe using option strategy to kind of sort of limit the downside, protect the alpha in the portfolio. There'll be 3 or 4 ways that you can manage the portfolio and manage risk, so navigate through that environment, so that when you come out of the other side, you're hopefully better positioned coming out of that versus the index, and you set yourself up well or better coming out of that into the eventual quads going forward.
Great stuff. All right, so we'll have more of these types of questions in the future. We'll take a couple from the audience. Hopefully, maybe we'll even have an email address for people to send that into at some point. We'll see. In the meantime, people can just hit us up on Twitter. All right, we're coming up on time, so I'm going to kind of finish up with some quick hits, and then we'll close it out. So maybe I'll stick to just kind of one. This is going to probably be a recurring one every week. I'll just go around to everybody. And myself last. Shiny objects. So what got your attention this week? Just something, any news article, insight, stock movement, something, just something interesting that got your the juices flowing. And maybe I'll put Bennett on the spot first and make him answer something from his trip out to Vegas.
Yeah, no, I actually go to. It's interesting. Maybe I won't go there. I'll go to the news this morning. I was gonna.
Well, you should tell me about that offline.
No, it wasn't bad. It was. Maybe I will. I went to a bunch of restaurants. The hashtag Hedgeye food tour that I went on, going to a lot of the Southwestern publicly traded companies at a lot of the restaurants that we don't have up in the Northeast.
My daughter is going to be very jealous of your job when I explain what it is that you do.
And so we went to a lot of restaurants, El Pollo Loco. We went to a Dutch Bros, which is really what I wanted to touch on. And maybe it's not a piece of news, maybe it's not shiny, but one of the things that did stick out was how small the sandwiches were, the sliders as they call them. It's the size of a Ritz cracker. I think if you gave that to anybody in New York City, they would throw it right back in your face because of the size.
They have White Castle.
Very cheap, yeah, very very cheap. But also one that, when you think about expansion, it was my first. It was new to me to experience that. Obviously, the drinks too sugary for me, but the line was wrapped around the block. People love this chain, high growth. But what stuck out was the food, right? Our question is, how will they get? Food is obviously a meaningful opportunity. Starbucks, it's below 20% of their sales mix, but still meaningful, right? If Bros can get there, it's a meaningful opportunity. Black Rock Coffee Bar already positioned for more positive scaling off of a better base. But it was interesting to see Bros. It was interesting to hear some of the feedback, and I'll stop there. That was my shiny object for the week.
I like it, but I know it's I gotta this is my attempt at branding. I gotta come up with like clever names for each of these segments because this is what we do in the world these days. All right, Sam, what's your shiny object for the week?
I think we touched on this on the call this morning. I think it's interesting to see some of these breakouts from long downtrends in the energy sector, and
I'll do a whole episode on this as a topic we're going to talk about.
Yeah, hopefully in the future with Fernando. But I think that's kind of what caught my eye, and I'm going to be doing a little work on that space in the next.
Yeah, there's a lot of signals fog in there. It's kind of interesting. I think my shiny object I'll pick was the Howard Marks letter. He was sort of like forced to have to pen something on direct lending because they are there, and I think they even had exposure to First France, so he sort of like had to write something. But his overall take I thought was a good one, which is like, yeah, credit has losses in it. Like this has always been the case. It's going to be the case. We've actually been in a period where there hasn't been this much. So surprisingly, like unfortunately, it will catch up eventually. And as to whether or not it becomes a bigger issue, I kind of go back to where I started the episode. Like, all depends on the direction of liquidity. Like, if you're waiting for this big shoe to drop in like direct lending, I'm like, they can extend and pretend that forever if the liquidity environment's really great. If it's not, well, yeah, then we'll find out. Then we'll know about like when the tide goes out exactly. Who has the trunks on and who doesn't. All right, let's fire off our pop culture minute. We already got Chariots of Fire for his favorite answer. I'm gonna go back to Bennett for best sports movie. What's the one you love the most?
David Salem had it wrong. It is The Blind Side. It makes me cry every time I watch that movie.
Even though the story may have been falsified.
I could watch. I don't care. It doesn't matter. I could watch that a million times and I would cry every single time. That is the most emotionally provoking movie.
That's an awesome movie.
Yeah. That's one for me.
All right, I like that. It's a good pick. That's a good pick. Sam, you're a movie buff. What's your favorite sports movie?
Yeah, this is a good one because you can categorize these movies in like movies that are specifically about the sport and movies that are specifically about characters, but with the background being the sport. So if I'm going to pick two because I think of those two different things, but I think in the latter of like character driven with sports as the background, I thought Raging Bull is probably one of the best movies that Scorsese's ever made.
That's a true film buff's answer right there.
Deep as the kid.
And the other movie that's kind of more centered on the sport itself. I recently watched this because the main actor passed away. But I thought The Natural was just a
that's up there.
Beautiful movie, just such a great story, and just if you love baseball, you love that movie.
No, that's and I'm not the world's biggest baseball fan, but The Natural is just I remember that one from when I was young. That's something like that movie was is great. It was in my contenders. Another one that's a contender of mine because it goes back to my my childhood because I remember this actually happening. I'm just old enough to remember this actually happening. Is Miracle with the U.S. Hockey team beating the Russians in 1980, and the absolutely travesty that it is that Kurt Russell wasn't nominated for a Academy Award for that movie. He's really incredible in it. But my actual answer, I was able to sneak in like two or three for my answer, but my actual answer, my favorite sports movie is actually Bull Durham. And even though it's more of a like romantic comedy in a ways, I just love the world weary nature of like the way like most sports things are like glamorize it, and these guys are just like the like blue collar sports. They're just like they're in the minor leagues, just schlepping on a bus from game to game, and it's just like the background of the whole thing is so great. That I think is my one of my all-time favorites. All right, well that's with that we'll close it out. Bennett, thank you so much for coming on, being our first official guest outside of Ham.
Thank you, Bennett. Great having you.
Thanks, boys.
So, and for everyone else, tune in to the next one in a few weeks. We'll probably skip the Thanksgiving week and do the next one in December. Maybe we'll even get Fernando on and we'll talk about some energy. I'm dying to get to that topic. So, in the meantime, you can follow me on Twitter or X. I can't stop calling it Twitter. At RP Kent. Sam is at Sam of America. David Salem's at D Salem Investor, and Bennett, you are
Hedgeye Food.
Hedgeye Food. That's an easy one to remember. There you go. All right. You can see our bios on the Hedgeye Asset Management site at hedgeyeam.com, and Bennett is up there on the team page for Hedgeye. And anything else to add? Closing thoughts?
We're all good, man.
Oh, you're all speechless.
Have a great week.
Is that good? All right. Okay. Great. All right. Best of luck out there. Hopefully, we'll see you for the next one. Thanks.